Now, for more on the U.S. economy and what it means for this election, I'm joined by Charles Sauer, president of the Market Institute. Welcome to the show.
Thanks for having me.
Now, Charles, we saw that the U.S. had stronger growth in the third quarter of 2.9%. What was your reaction to that data?
Well, 2.9% is big growth. That, as you pointed out earlier, that's twice last quarter, and it's the largest growth that we've seen in over 2 years. But if we look out longer term, this is the slowest growth that we've had as an economy since 1949. The growth that we've seen under President Obama has been about 2%. That is not historically anywhere near the growth rate that we've seen as under Reagan, Carter, even Kennedy. Again, going back to 1949, most of those presidents have seen economies that were growing at over twice that speed.
So let's have a look at what's behind this growth. As you're saying, people should kind of taper their enthusiasm. So what were some of the main growth drivers in this past quarter?
So the big growth drivers were both trade and rising inventories. In fact, if we take trade and rising inventories out of the GDP, what we saw was 1.4% GDP growth, which is the same as happened last quarter. But there was a bad farming quarter in South America, and so there was a spike in soybean exports, which is exactly what is increasing the growth now. Whether that continues or not, I don't know, but I think that the rising inventories are something that we're going to look for growth in the future. Businesses don't start bringing in inventories unless they're expecting to sell, and GDP is this aggregate statistic that lets us see what businesses overall are doing, and so I think that that looks good for fourth quarter growth.
Now, what about the things that don't look so good? What are some of the potential headwinds?
Well, again, we have low labor force participation rate, so it's hard to get growing. We have oil prices that are still lagging, and what that has been having is this follow-on effect through the economy. The North Dakota oil fields are almost shut down. Oil fields in other parts of the country are slowing down, and all of the supply fields that go into them are slowing down. Now, there's word that some of them are, as oil prices are picking back up, that we might see that start to turn around, and that could be a real boon to the economy. But until we see oil prices go up faster, I think that we're still going to have this sluggish, almost anemic economy.
And one thing that's not helping is there's a lot of this wait and see as businesses and investors are really looking to see what's going to be the outcome for this election. So in terms of the impact of this election cycle, what is that doing to the economy right now?
Businesses don't like volatility, and so you're exactly right. If somebody's looking to make a major investment or change their business decision, they're just at this point going to wait until November 8th. But this election, Hillary Clinton's been polling out ahead almost 6 and sometimes 8%. The projections put her at 99% chance, 92% chance of winning. The lowest poll that I've seen shows her at an 80% chance of winning the election. And so I actually don't think it's creating that much of a drag on the economy. Businesses are fairly sure that she's going to be elected. Donald Trump doesn't have much of a ground game. That might have all changed today with a major announcement from the FBI, though.
Now, speaking of that, as we have this controversy, but also looking against the backdrop of how the economy is doing, what do you think this is going to do in terms of the Fed and whether it'll make a decision by the end of the year?
Well, I think Janet Yellen has been a Fed president who has been steady with the way that she looks at things. She doesn't want to rock the boat. She doesn't want to move too fast. But the last time the Fed raised rates was almost a year ago. And we see what she's doing moving into the December meeting. I don't think she's going to do it at the next meeting, but we can be fairly assured she's going to raise interest rates at the December meeting. That's also going to be another boon to exports in the next quarter as well.
And speaking of that, speaking of the next quarter, what should we be looking at then in the short to mid-term? What could the growth prospects look like?
I think the growth prospects are good. This is really hard to see because as you adjust the numbers, it's hard to know how the adjustments are going to happen. But again, we have rising inventories. That's a good sign that businesses are looking for a good fourth quarter. We have Janet Yellen's going to raise the interest rates. That's a sign that the economy is doing well, but it'll also bring the dollar down a little bit, which makes for other countries imports cheaper, and therefore our exports should increase. So the fourth quarter is looking good, and hopefully the economy will keep growing at maybe even a faster speed.
And just quickly, you did mention that rise in exports in the third quarter. What's driving that?
So that was soybean production. So South America, Argentina, I think Brazil all had a really bad soybean crop this year. And so what that meant was when the U.S. came out with their soybean crop, which we do in the third quarter almost every year, and there's this spike, but the demand had increased. And when demand increases, so does price, and that meant a good quarter for our soybean production.
Well, we'll certainly see what comes of everything. Thank you so much for joining us. That was Charles Sauer, president of the Market Institute.